Hello. Welcome, founders. 30 seconds early, but welcome. We got a belter of a topic today. I mean, I write a lot about mistakes, so to speak, of what founders may be making, and these are based on my experience, right? So I get a ton of pitch decks on my desk directly. So they come through LinkedIn, for example. Someone DMs me and says, we have a venture, and would you like to, hi Simon, welcome. Would you like to, take a look? And then I just do a 30-second, maybe a minute kind of quick review of who sent me the DM and if there is anything of interest there. And sometimes the messages, the DMs are pretty vague, right? So it might say, hey, we're working on an AI-based SaaS platform for the pet sector. I would like to jump on a call with you and discuss it. And I'm like, okay, what are you looking for? Don't be vague. Don't be kind of open-ended, right? So anyway, and then we get a lot of pitch decks come in through our syndicate, through our network. So what happens is, for instance, so the way the syndicate works, and this is for people who don't know how a syndicate in terms of angel investors works, right? So what happens is angel investors like myself, 3, 4, 10, 12, there are some syndicates which have 50, 100, but that's a bit too much. The syndicate that I'm a part of, I've been a part of it for many years now, and we try to stay really small, about 12 angel investors. So what happens is all of us, when we get pitch decks in front of us, if they're not interesting to us as angel investors, we then put it out onto the syndicate network, right? So we have our own Slack channels and all that. And so somebody else may be interested in it. And so coming back to my point, mistakes, when I say common mistakes, and that's what we're looking at today. A lot of people don't like to use the word mistakes, but I think it's okay because it is a mistake, right? It's unintentional for lack of, I don't know. I wouldn't say knowledge, but just awareness. So today we look at about 10 common mistakes, and I've written a lot about these mistakes. And today I just want to talk about it, right? So let's go on to that. Okay, so obligatory presentation, and then I'll open the floor for Q&A, and I promise I'll try and go really fast. Common mistakes founders make when raising seed funding. The first one, not doing enough market research. Many startups don't spend enough time understanding their target market and customer needs before seeking funding. It's essential to have a clear understanding of the problem you're solving and the value proposition for your target customers. Now, on the face of it, this may seem like pretty advice, and you're like, hang on. If we are developing a SaaS platform or a product, the founders must have, looked into the target market and research the avatars and all that. Yes and no. You'd be surprised when I've seen a lot of examples where it's a great idea, it's a great product, but then when it comes to market research, it's very unidimensional or single dimensional, right? So when I ask the founders and I say, okay, have you done a buyer persona? Have you done the archetypal analysis, right? So where you're building up the buyer persona or the customer avatar based on solid principles, not just, it's men in their 30s, 30 to 50s who are making $150,000 and then per year, and then they have this problem that we're going to solve with our product. That's pretty good, yeah, but that's not enough. That's just demographic. What you need to do is psychographics, right? So psychographics is where you are building up these archetypal kind of avatars. And so it's not just their age and their demographics and what they're making and why they might want to buy your product because they have a pain point. It's much more than that. What is the worldview of this target audience? How do they think? Where do they hang out? And everything in terms of psychographics. Why? Because when you think you're solving a certain problem and with your product or service, actually, when push comes to shove and you are going to be charging for your service, you might be surprised. You might start realizing that people are not really that enthusiastic. So yeah, okay, I don't want to harp on about this, but it's a very important point. And I've done a few videos on archetypes and all these things, but if you have any questions, just hit me up. Number 2, overvaluing the company. Oh my God, this I see it 100% of the time. Startups sometimes have unrealistic expectations about their valuation, which can lead to difficulty in securing funding. It is important to be realistic about the company's current stage of development and potential for growth. Okay, so every single pitch deck that I've seen and a conversation with a founder, when they say we're offering, we're looking for $500,000 seed funding for 2% equity, discounted at 20%, blah blah. And I think, okay, so if you're asking for $500,000 at 2%, that means you're valuing your company, wildly, right? And this is because it happens because founders are afraid of giving away too much equity in their venture at the seed round, which is awesome. That's the right way to think. But giving away too much, you're not going to prevent that by simply valuing your startup at an unrealistic valuation and then saying, okay, if I value it at, I don't know, 10 million, then the 500,000, I would have to give away a small percentage. It doesn't work like that because valuation is it should be real. It is what is your company worth now and what is it going to be worth later on. Now, when an investor is looking at it, okay, they want to know what it is worth now because they're putting their money into the venture as it stands now. It could be worth $100 million next year, but hey, it may not, right? It's a gamble. There's so many factors, there's so many variables, and it could be a war somewhere. It could be regulations changes. It could be inflation. It could be anything. And then your growth may not hit that valuation. So you cannot, think about and believe that valuation at this moment. Okay, that's a whole different topic. And you know what? I might do a live episode next week on how to really value your company. How do you do the evaluation in a realistic way, right? That's a different topic. So let's not go into that now, but think about it, right? Remember this. Overvaluing your company is a no with investors. No. Okay, number 3, lack of focus. Not a big one, but it is surprising how many times you see this. Some startups try to do too many things at once, which can be overwhelming for investors. It's important to have a clear, focused plan that demonstrates how your company will achieve its goals. Now, what I'm trying to say here is I see again and again pitch decks that come in that talk about the problem they're solving, but also to try and build this expectations of an ecosystem around this. So they might say, okay, right now we're solving this, but then the customers in this sector also may want a learning portal. They may then look for service oriented. They may blah, blah, blah. Okay. It's good to have that as a part of your business plan, but really only as a footnote. Because think about it. Investors, yes, they would be interested to say, oh, okay, so there is a lot more potential for this than just the current one. But then, like I say every single day, investors are not fools, right? They're not fools. investors, usually very experienced, they're sitting there, they've seen a ton of startups, they've probably invested in a bunch, they've had terrible disasters where they lost a ton of money, they've had some good ones where they made 3x, 5x, 10x, 100x. So you don't need to try and motivate them with future potential, right? You don't need to do that. Just leave it as a side note. Poor communication, OMG. Founders who struggle to articulate their vision and strategy may have difficulty securing funding. It's important to practice and refine your pitch so that investors can clearly understand the value proposition and potential for success. Now, a lot of founders think that the pitch deck, once they send out a pitch deck, that's it. That investors may just have questions. But hang on. In fact, even when if an investor shows interest, communication is everything. Your DMs, reply back to their email. It could be a WhatsApp message, a Slack, whatever it is that they initiate. And they might say, let's jump on a Zoom call, just a discovery call. I just want to know. That is a pitch. Okay, so they might say, I don't want you to present anything to me, but anything you say is a pitch. Every single touch point is a pitch. Your email is a pitch. So communication, my friends, communication, articulating, okay, doesn't mean that you need to have these really, stuffy paragraphs or sentences and then you keep reading them out. No, that's not what I'm saying. You need to have a very, very laser-like focus in terms of what your vision is, right? What your strategy is. Not just your product, what it solves, why now, and all those, yes, but primarily, and we're gonna talk about that in depth in another point. But communication is key. Not building relationships. Okay, I keep on harping about this, and you guys probably know a lot about this, but let's talk about it anyway. Networking is essential for startup success, and building relationships with potential investors and mentors is key. Building relationships. Make sure to attend events, meet with investors regularly, build a strong support network. Okay, so the point is that you need to be, okay, let's just take a step back. Let's say you're a founder, you're bootstrapping your venture, you're not ready to go for funding yet. Okay, so maybe your MVP is not ready or your pitch deck is not ready. At that time, you got to keep building relationships, okay, with investors. What that means is you don't just knock on an investor's door when you need the money. You need to keep building a relationship so that when the time comes, you then have a warm introduction yourself. Or that investor or that mentor or that entrepreneur or even other startup founders that have made it big, like they have 2 or 3 exits under their belt, and they've streamlined the process of building a startup and then making some money off it. Reach out to them, build a network, right? Ask them questions, engage with their content. And I don't want to go into that part of it. That's a lot of people talk about that LinkedIn, but it's look, you got to keep it genuine, right? Build a genuine relationship. And I know it's very difficult because everybody on LinkedIn, for example, or it could be Twitter, everybody is there to sell something, right? So it's difficult to build genuine relationships. It is really tough to build genuine relationships, but you got to figure it out. Maybe that's a video for another day. Failing to articulate a clear vision. Okay, a common mistake that founders make is not being able to communicate a clear and compelling vision for their startup. Okay, I don't know what's going on with my camera. Let me see. Let me see. Is that better? Yeah. Is that glitching? Seems to be glitching. So let me go back. That's better. Okay, so a common mistake that founders make is not being able to communicate a clear and compelling vision of their startup. It's important to have a clear understanding of your market, target customers, and value proposition, and to communicate this clearly and concisely to potential investors. Okay, this is what I was mentioning before. I think it was point 4. Okay, you really need to build a brand strategy for your startup, right? Even if you don't have your product ready yet, you're not ready for the market, whatever, right? Even if you're not ready for funding, build your brand strategy. What does that mean? A brand strategy is your brand story told effectively, right? And the brand story is not your origin story. So it's not how you came up with the idea. That's good. That's a part of the brand strategy. But a brand story, initially, when you're seeking out funding, the brand story is for the investors. And once your startup launches, your brand story is for your consumers, right? Your customers, your target customers. And for that, you need to sort of work out the core principles, the fundamentals of your brand. And this is, of course, your core vision, right? Your mission, your kind of core values, your what do you call that? Dictionary of core terms that represent your core values, your brand story, your core principles, all these things. Anyway, there's many, and I'll do another video. I'll do another live episode just on that, and to get me started, because I go into a frenzy when I talk about that. So you need a compelling vision, and a vision is not just about what your product does or what your venture is about, but it's the bigger thing. Okay, why should the investor care? And I keep telling you, investors are not fools, right? So investors care about the bigger picture, not just the features or the problem you're solving, but a bigger picture, a 30,000 foot kind of a vision. What does your company stand for? What does your brand stand for? Okay, what do you stand for? What are your core values? What do you care about, right? Why do you get up in the morning to do what you do? Yeah, okay, like I said, that's a big topic. We'll go into that in a different episode. But yeah, you got to work out your value proposition. Value proposition is not just, I'm solving this problem and we are better because our platform uses, okay, those are all good value propositions, but you also need to have a startup value proposition, something that is compelling, that's something that the investor says, you know what, I actually agree. I'm glad you said that. And yeah, you know, you're someone I want to work with. The investor should say to the founder. So you got to figure that out, right? Okay, let's move quickly on. Overestimating the market opportunity. This is one of my favorites. And I keep ranting about this, right? Every single opportunity I get, I rant about this. Another common mistake is overestimating the size and potential of the market. It's important to conduct thorough market research and analysis to ensure that there is a real growing demand for your product or service. Okay, so a TAM, a total addressable market. And people just, yes, it could be $1 trillion market or $100 billion market. And the TAM is 10 billion. And then we're going for 10% of it, 1%. Guys, please, and gals, don't overestimate the market opportunity, right? Do solid research, right? Reach out to people who can help you understand the market opportunity. Pay someone for this, or pay a company to create that market research report, or find a mentor or an advisor who can then work with you to figure it out, because investors are savvy, right? They're clever. And they know, look, if an investor shows interest in your venture and is asked for your pitch deck, 80% of the time, they probably know your sector. That's why they're interested in the first place. Or they're part of a network that deals with your sector. So they probably have a lot of sector knowledge, right? Specialized, deep knowledge. So don't try to bullshit them, man. Don't try to put these huge numbers because you think that the investors are going to salivate looking at 100 billion, 10 billion, 1 billion. They won't. They're probably looking at it and laughing their ass off, right? So be very realistic. What that means is truly, it could be $1 trillion market, but look at your go-to-market strategy. Do you have one? If you don't have one, that's a whole different thing, right? We can talk about that in another episode. But go back to your GTM and look at your GTM and then project the potential market you would reach through that GTM. If, for example, your GTM is going to be, I'm going to have 10 guys or gals sitting, manning some phones, and they're going to make some cold calls, and we're going to reach out to people. Look, yeah, in a miraculous universe, yeah, you may reach out, 1 million people a year, but realistically, what? You probably reach 1,000 people. You see what I'm trying to say? So your market, it doesn't matter if that sector is $1 trillion sector. That's not in. Yeah, don't get me started on this, man. I really get frustrated with this, and I keep harping on about it. And yeah, okay. Number 8, underestimating the importance of the team. OMG, yes, another big one. The team is a critical factor in determining the success of a startup. Failing to build a strong and capable team with relevant experience and complementary skills can be a major red flag for investors. Okay, 98% of the pitch decks that come on my desk, when I go to the team slide, it has 1 or 2 people, and they're usually co-founders, which is good. Look, maybe you're bootstrapping. Maybe you don't have enough money to pay people to come on and or all that. But team is not just the founders and the co-founders, right? It's advisors, it's mentors, it's people who have specialized industry knowledge who are interested in your project. And go and reach out to them. And they don't need to do any work. Say, listen, at the moment, I cannot pay you, but you don't have to do anything. If you believe in this project, would you be a part of my project once we get funding? And a lot of people will say no. Yeah, they'll say, no, you know what? I got no time right now. And, I already got lots and lots of inquiries. People, startups want me on their advisory team, and I charge. That's fine. But you will find someone who might say, actually, you know what? And of course, you got to do everything before in the proper way for someone to say, you know what? I believe in your vision. I love your strategy. I love your whole, pitch and blah, blah, blah. And I think, you know what? Once you're able to pay me, I would love to be a part of your project. And it's okay, right? If someone says pay me, I don't know why, people run away. Look, when someone says pay me, they don't mean right now, right? So anyway, you gotta build a good team. You gotta show a good team on the pitch deck, right? For investors to be interested in. Okay. 9, failing to demonstrate traction. Demonstrating early traction, such as user growth, revenue, or partnerships, is a strong signal of future success. Failing to demonstrate traction can make it difficult to secure funding. Okay, a lot of people think that traction means only revenue, right? When we say, do you have any traction? They're like, no, we're not. We're still in the MVP stage. We're not making any money yet. Hey, traction doesn't necessarily mean revenue. And investors are not stupid, right? Seed funding especially. If you're bootstrapping, and yeah, there are many startups who are making revenue even when they're bootstrapping and when they get to the seed stage, but investors know that 80% of the startups that are bootstrapping, that are looking for seed funding, they're not making any revenue. So when they say traction, it's not just revenue. There are other things such as growth, user growth. That's why you need to get your MVP out there and, invite people, get some users to start testing it. Because if you say, yeah, we don't have any revenue yet, but we have about 500 people on the system already, they're testing it out, and these are just, random users, they're not paid testers, that's good traction, right? Or partnerships. You could say, well, this is a leading complementary kind of a brand or service within our sector, and we have a letter of intent from them that if we deliver on this solution, this platform, this whatever, they may be interested in partnering with us. That's good. That's traction, right? Okay, so have at least one element of traction in your pitch deck. My friends, Figure it out, right? Okay, number 10, ignoring legal and regulatory compliance. Okay, this may not apply to everyone, but it's something to think about. It's a lot of people don't think about this, especially if you're a tech startup and you're dealing with AI, or you're dealing with, I don't know, data, privacy, user details, and all these things. Startups need to be aware of and compliant with relevant laws and regulations. Failing to comply with legal and regulatory requirements can lead to legal and financial problems down the road. And more importantly, you know what? Not talking about it, not even mentioning it in a pitch deck, that's criminal, right? So, and like I said, investors that would be interested in your pitch deck, they probably know about your sector. So they know, the laws and all that. Compliance. So if there is anything that needs compliance, mention it, right? It doesn't mean you need to be compliant. That's down the line, but at least now mention it if you're in the process of building your software, whatever it is, right? So that is the last one, and that is my obligatory kind of slide deck, right? Those are the 10 common mistakes. And there's many more. I'll probably do part 2 another day. Let me go quickly to see if there's any questions for me. What's the strategy when it's really a complex offering, AI-based maybe, or complicated financial instrument? And this is to slide 6. Okay, let me go to slide 6 and see what that is. Yeah, just bear with me. Failing to articulate a clear vision. Okay. Simon, that's a great question. So Simon asks, what I said that you need to articulate a clear vision, right? And he's saying, what if the idea is complex? And it could be AI, it could be crypto, or it could be a financial instrument. It could be a fund that leverages several different instruments, or, all these things, right? And some of these ideas are really complex. Okay. There is a 2-part to that. The first is that if it's a really complicated solution to a complicated problem in a complicated sector, then the investors would probably be up to speed on that, right? They would understand. And therefore, you can be very, very detailed in your pitch deck. But you do have to articulate that into a vision, okay? Because think of it as, what if the investor in front of me has no experience with this sector, but they're excited by this. They want to get in, and they think, okay, you know what? I don't want to be a lead investor, but if someone else is pitching in, I don't want putting, $500,000 into it. Now, how would I, 10-cent style. How would I explain this to a layman? Think of it from that angle and tie that back to your vision. If, for example, like Google, they wanted to categorize and catalog the world's information, right? That is their vision. But their product is an algorithmic search engine that uses hash tables and, that uses page rank, the flow of reputation between pages through links and blah, 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 blah. But their vision is that they wanted to catalog and make relevant the world's information. So you need a tagline. You need something to articulate your vision, and then the details. 10-cent. Now, okay, to be honest, when you have something like Alphabet or 10-cent, when they have 100 products, you know what? They're probably not pitching a seed funding round. So they probably started with a simple premise and then later on picked other things. But what I'm more interested in, Simon, is, the BlackRock thing we were talking about and your own fund we were talking about through messages. That, yes, that probably needs to be articulated, because I read through that and I was thinking, okay, this sounds complicated. And I'm not a financial guy, right? So I have partners who are well-versed in finance. They've been managing hedge funds, so they understand that. But someone like me, I don't think I would understand a lot. Well, I do know, financial aspects because I've been in the startup world forever. and I've angel invested in a ton. I've advised, literally hundreds of startups, and I've exited successfully 4. And so I know a lot of the financial implications in the startup world, but I don't know, for example, financial instruments, leveraging in the stock market, and all that. So yeah, articulating that is important. All right, people. Questions, come on. How to explain it to public as a product? Okay, give me an example, Simon, and let's try and talk it through, right? Give me an example, and let's see if we can talk about it as a product. Sorry, guys, I'm just waiting for Simon to give me an example. But in the meanwhile, let's touch upon any other points that I may have missed. I may talk about in the future. I mean, there's lots of things that I want to talk about in terms of mistakes, but I realized that okay, Simon has come back, says, so mortgage-based securities where the house is a venture. Okay, and I can understand this. I don't know about mortgage-based securities, but I can talk about something else that I'm currently actually investing in. This is to do with investment assets, right? The asset class. And these are luxury kind of assets. This could be premium wine, for example, or artwork. And we're working through an NFT kind of idea behind it. And it's very complex to explain that as a product, because when you look at it, you have a premium wine. And in this case, it's a house, right? And we're looking at the house as a venture. What that means is the house, you invest in that house, and the house is a business. So, and look, Simon, I might be talking through my ass here, right? I don't know the exact details of this. So I'm just picking that up and running with it so that we can talk about it and use it as an example. So I may be completely wrong, but this is not about right or wrong, because I'm not trying to provide answers, specific answers on this live show. What I'm trying to do is helping founders the way to think through these things. And that's where the value comes from. And that's what I do in my advisory anyway. So, so if I wanted to say, for example, that I want people to invest in bottles of wine that are going to be stored somewhere, and then they would be auctioned, or people would buy them, and so on. And every time a transaction happens, you get a part of it, right? Then I would look for an analogy. I would look for an analogy in the real world, completely like in the retail sector. This could be a store. This could be a supermarket, something like that. For instance, your mortgage-based securities where the house is a venture. If you were to extrapolate that to a supermarket, what would it be? What is this house in terms of the relationship between the supermarket and the consumers? When they come into the supermarket, they're buying some stuff, they're leaving. Is there a connection? Can you find a connection? That's the way to think about it, right? So, and I'm not saying dumb it down, because someone who is looking at your pitch deck and potential investor in the mortgage-based securities sector, they probably know what you're talking about. So you don't really need to dumb it down. But then the odd fish like me may be interested in this. So for them, it's always good to, yes, you become the investment banker. I love that. So the person who invests in this, and it's broken down, just like tokens, right? They become investor bankers. So everyone who invests becomes an investment banker. Now, what is an investment banker? You can take an analogy of the investment banker and explain what an investment banker does, right? And that way, you're communicating. You're communicating the vision of this product without going into the technical details of what this security is, how it is, transacted, what is it regulated by. All those will come in the appendix and all that, right? I hope that helps. But yeah, so guys, it looks like there are no other questions. We're already past the half an hour mark. I hope you found this episode, live episode, interesting. No, unfortunately, no one came online to jump on the video call with me, but maybe next time. You know, let's go for a time when you can jump on a live call with me. That would be fantastic. You can ask me questions and all that. All right. So tomorrow I come back, another episode live, 10:30 Eastern Standard Time on LinkedIn, on Twitter, on YouTube. If you have any questions, DM me on Twitter if you're on Twitter, or DM me on LinkedIn. It's Bunigala, Mash Bunigala, and ask me questions so that I can answer them in the live call. All right. Till my next live episode, go forth and prosper. All right. Take care, guys. Bye.